Coca-Cola stock just released their latest quarter's earnings, and for a company that typically sees very little volatility, they've moved a lot on the day. They're currently up nearly 4%, which again is pretty rare for a stock like Coca-Cola, and this puts them fairly close to their all-time high, currently trading at about $71.04 per share. Now, if we look at them in the last year, they've traded relatively flat, currently up by only around 2.3%, but if we look at them in just the last month alone, they're already up by over 7%. So let's go ahead and dive into this recent earnings report. What did it look like? Well, right from the get-go, we can see Q3 non-GAAP earnings per share of 82 cents was a beat by 4 cents, and revenue came in at $12.5 billion, up by 5% year over year, and was a beat by $90 million. So this company saw beats on top and bottom lines, and obviously the market responded accordingly, up by about 4%. But there's more that we have to break down when we look at Coca-Cola stock. Now let's pause right there for a moment. What's the most comparable stock to Coca-Cola? It's Pepsi. So if we jump over to our stock comparison sheet, let's go ahead and look at Coca-Cola compared to Pepsi right now. You can see all this data will load into our spreadsheet, and like always, if you'd like to download this sheet or any of the other spreadsheets you see and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, what we're seeing with Coca-Cola and Pepsi stock has been interesting over the last couple of years. For one, if we look at Pepsi in the last year, they're down by about 12.63%, which again, versus Coca-Cola in the last year, they're up by about 2.16%. Two fairly comparable companies, but radically different returns. What's also interesting about this is if we look at the historical growth of the fundamentals, Pepsi's been growing revenue faster, they've been growing earnings per share faster, and they've even grown free cash flow per share faster. At least, that's what it looks like at first glance, but these numbers certainly don't tell the full picture. Another example of this is, for example, when we look at these dividend metrics, we see a free cash flow payout ratio for Coca-Cola of 176%, which is obviously a major red flag. That means the dividends probably aren't sustainable, and for Pepsi, it's at 100% also, another red flag. But if we start to dig into this a little bit more, we start to get some answers as to why the numbers look the way they do and why one of these investments looks quite a bit better than the other. Now, when we look at the dividend metrics for Coca-Cola, what do we know? The starting dividend yield around 2.85%, and this company's a dividend king with over 50 consecutive years of dividend increases. You can see the dividend growth history here. Typically, the 10 and 5-year dividend growth is a little bit above 4%. But this is the red flag. Why is the free cash flow payout ratio above 100%? Well, if we look at the free cash flow versus dividends paid out, particularly last year, we can see 2024 free cash flow took a dive and went from about $9.7 billion all the way down to around $4.7 billion, while dividends paid out was about $8.3 billion. Why is this the case, and will this continue to be the trend moving forward? The short answer is no, this will not be the trend moving forward. If we go back and look at Coca-Cola's fourth quarter and full year 2024 results on the SEC website, Securities and Exchange Commission, right here we can see free cash flow excluding the IRS litigation deposit was $10.8 billion. So essentially, because there was a one-time IRS tax litigation deposit, it substantially lowered free cash flow in 2024. Without this, free cash flow would have been about $10.8 billion, or actually up by 11%. 11% free cash flow growth is phenomenal. It's pretty good for most businesses, but for a company that's existed for as long as Coca-Cola, it's just amazing. Because we're talking about a company that typically grows revenues around 4, 5, or 6%. So at $10.8 billion, which it would have been, that would have easily covered those dividend payments. So the question is, what type of guidance did Coca-Cola management actually give as it relates to free cash flow moving forward? Well, if we jump into the recent earnings release and look at the outlook for full year 2025, down here it states, the company expects to generate free cash flow excluding the Fairlife contingent consideration payment of at least $9.8 billion. So this is the low estimate that they're giving. And it's actually a little bit higher than what they were previously expecting. It was updated from $9.5 billion. This is another reason that the market is currently bullish on this stock. So at $9.8 billion, yes, all of a sudden that dividend payment is going to be covered by free cash flow again, meaning that dividend as we move forward looks sustainable. So these negative compounded annual growth rates as it relates to free cash flow, a little bit misleading due to the 2024 IRS tax litigation. Meanwhile, for Pepsi, they don't really have that excuse. Their free cash flow payout ratio is right at 100%. Now, if we dig into the fundamentals of Coca-Cola just a little bit more, what we can see for Coca-Cola is revenue per share, especially since 2020, has been going in the right direction, going from around $7.69 per share to in 2024 $10.92 per share. And during the same time period, the debt to assets ratio has come down, coming to really a healthier level, but for the most part, they're in a good range. Now, if we look at that recent earnings report, one of the things we can see is their third quarter results resulted in net revenues growing in about 5%, and organic revenues grew by about 6%. This is typically the range that we want to see Coca-Cola in. Now, when it actually comes to growing earnings and growing bottom lines, yes, revenue growth obviously plays a major role, but one of the other options is expanding margins. So what does that gross profitability actually look like for Coca-Cola? Well, we can see the 10-year average gross profit ratio is sitting about 60.49%. So for a company operating in their sector, that's actually a decent profitability ratio in my opinion, and we can see last year is about 61.06%. So since 2020, the profitability ratios have been expanding a little bit. And if we look at the comparable operating margin non-GAAP for Coca-Cola in the recent quarter, it was 31.9% versus 30.7% in the prior year. So to be completely transparent, I'm actually quite impressed with the results that Coca-Cola's posted in the last couple of quarters. They've definitely exceeded my expectations. And I actually say that as a shareholder of the company. This is not a stock that I've added capital to in many years because I bought in at such a great valuation back in 2020. But overall, the valuation has continued to go higher since then, and revenue and earnings really aren't growing at as high of a rate as I'd personally like to see for the holdings in my dividend growth portfolio. But with that being said, there is something that Coca-Cola excels at, and that's predictability of cash flows, and also the stability of the business model. When we talk about valuation ratios, for example, the forward PE ratio for Coca-Cola is sitting at 22.99. How do investors decide what type of valuation multiple they're willing to pay for a stock? Well, typically there's two things we take into consideration. And this is something I was talking about over on Dividendology.com just the other day. Stocks that have the ability to outperform over the middle to long term usually do so due to growing earnings at a high rate, but also having the ability to see multiple expansion. Now, the reality of multiple expansion, meaning investors willing to pay a higher PE multiple, is typically driven by how fast earnings are growing and how predictable the future earnings of the business is. And so even though Coca-Cola isn't necessarily growing earnings at a higher rate, we saw revenues growing at about 5 to 6%, earnings will probably follow. What they do have is a very stable and predictable cash flow stream. And it's also a very durable business model as we've seen over the decades. Because of that, Coca-Cola has often traded at a premium. But what's interesting is if we look at the valuation right now compared to how the stock has historically traded, even though they're close to an all-time high, we can see if we look at the PE non-GAAP ratio. Right now, Coca-Cola is trading about 4 to 5% below the historical valuation multiples. If we look at it on a GAAP basis, trailing 12 months, they're about 10.5% below their historical multiples. So is Coca-Cola still actually trading at an interesting price? Well, let's jump over to our valuation spreadsheet and see if we can answer that question. We'll plug in our stock ticker, Coca-Cola, and let's look at a few different valuation models. Now, we just touched on historical multiples valuation, but this puts it into a little more perspective. Now, to start off, obviously, we need to remove this outlier as it's going to mess up our data set. If we do that, we can see the average PE ratio over the last decade for Coca-Cola is actually about 27.24. If we look at it on a trailing 12 months basis, they're closer to about 23.34. So right now, they're about 14.3% lower valuation than what we've seen historically speaking over the last decade. Now again, in some instances, a lower valuation multiple makes sense if the business model is deteriorating or if the company is simply projected to grow earnings at a slower rate. That's something to keep in mind. Now, if we move forward and look at the multiples valuation model, again, there's not a lot of great comparables for Coca-Cola. If you take these two companies into account and apply their average PE ratio, you'd come to a valuation that's much higher. But the reality is, I don't think Coca-Cola right now deserves to be valued the same way that, for example, Monster Beverage Corporation is, which really leaves us with just Pepsi. Now, if we applied Pepsi's PE multiple to Coca-Cola, they'd be worth about $88.29. But again, while they are very similar, what's actually going on fundamentally with the businesses right now is pretty different. Coca-Cola is seeing much more organic growth than Pepsi, and Pepsi's really struggling from a capital allocation standpoint. They're not generating enough free cash flow to fund their dividends, to fund their buybacks, and obviously they're also attempting mergers and acquisitions to fund growth, which can be a dangerous game to play. So in all reality, this is not a valuation model that I would rely on in this instance. But one model that I do think is decent when it comes to Coca-Cola is using the dividend discount model. It values a stock based on how much they're paying out in dividends and how much that dividend is projected to grow in the future. And with the stock currently growing free cash flow revenues at a rate of about 5 to 6%, at least that's what management is guiding towards, we can assume they can grow that dividend at a rate of around 5% moving forward, which would give us a dividend discount model price per share of around $60.45. Now, what's interesting is that's still around 14.5% lower than the current share price, which really just goes to show you the type of premium that investors are willing to pay for this business. So here's what you need to know about Coca-Cola. Things are actually going pretty well internally with the business right now. They're definitely outperforming their peer Pepsi from a fundamental standpoint. But even with that being said, this is a very mature company. They're using the majority of their capital to pay out dividends. You can see the free cash flow payout ratios typically sitting around that 80% range. There's not a lot of opportunities for the company to reinvest back into the business and generate high levels of return on invested capital. You can see return on invested capital over the last few years is typically around 10 or 11%, which is decent. It's somewhat average for a more mature business. So if you're a long-term investor, maybe a long-term dividend growth investor like myself, looking for stocks growing earnings and free cash flow at a high rate so they can grow dividends at a high rate, this is really probably not the best opportunity for you, at least at the current valuation. But if you're someone looking to avoid the volatility of the market, buying into a business that's proven to be very durable, that can maintain those dividend payments, and you'll get a starting dividend yield close to around 3%, then maybe this is a company that you should consider keeping on your watch list. Again, I have to admit, the results they posted in the last couple of quarters are certainly better than I would have expected. So go ahead and let me know what you think of Coca-Cola in the comments down below. And again, like always, if you'd like to download any of my spreadsheets and get access to the Ticker Data add-on on Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.